Hi, this is Santosh Singh. I'm a petroleum consultant and I do financial and fiscal regime modeling for oil companies. In this video, I'm going to talk about royalty tax fiscal regime. As a thumb of rule, royalty tax fiscal regimes are very popular, and more so in the case of developed countries like UK, Norway, Netherlands, or other OECD countries, or countries like USA and Canada and Australia. Whereas fiscal contracts based on profit sharing contracts, they are more popular in African continent and Southeast Asian countries. So let me begin by showing you the distribution of profit in a royalty tax based fiscal regime. Let's assume that we are working with 1 barrel of oil. You can also consider this 1 barrel of oil in terms of dollar amount by converting that volume of oil into dollar by multiplying your 1 barrel with the price of 1 barrel of crude. Suppose your crude price is $100 per barrel, so this 1 barrel is equivalent to $100. Now in a royalty tax regime, there are three basic features. The first one is the royalty calculation, the another is tax calculation, and the third one is bonus payment. Bonus payment may or may not be part of a royalty tax regime, but generally they are part of any fiscal contract. So if this is your 1 barrel of oil, then you need to pay for your bonuses, and that will go to the government kitty. You also need to pay for your royalty because you have produced 1 barrel of oil. You need to pay royalty to the government, and that royalty goes to the government treasury again. Now whatever is left inside the barrel is your pre-tax cash, but this is not the actual pre-tax cash in your hand because you have not considered your cost. So you need to consider your cost as well, and when you extinguish this revenue with this cost, whatever is left is your before tax cash flow, and that is the actual cash in your hand before you pay any taxes. In a royalty tax regime, you have to pay a tax to the government in most of the cases, and so now whatever is left is your actual after tax cash flow, and this is the portion of cash flow which belongs to you. So this is your take, and we see there is a clear-cut division of cash flow between government and contractor. The government gets bonus, royalty and taxes, whereas the company gets a company's after tax cash flow. So this is how a royalty tax regime works. Now let me show you the basic workflow for the calculation of cash flow in a royalty tax regime. There are 2 or 3 layers of calculation. The first one is the calculation for revenue, which consists of your oil revenue and gas revenue or any other stream. Then comes the calculation for royalty, and you also need to calculate for your bonuses. So the second layer consists of royalty calculation. The third layer is the calculation for deductions. Deductions are important for tax calculation because not all of your cost is allowed for reducing your taxable income. So you need to figure out your total cost, and then you need to figure out your deductions, which means which costs are allowed for taxable income and which costs are not allowed for taxable income. Once you know that what your costs are and what your deductions are, you can figure out very easily what is your taxable income, and based on your taxable income you can calculate your taxes. Your taxes could be, again, several layers of taxes. The most common is corporate tax, and generally there are a few other taxes as well, like special taxes or special petroleum tax or petroleum profit tax or windfall profit tax. So these are the basic calculation for royalty tax regimes: your royalty, your cost deductions and taxes, and then what you end up is your after tax cash flow. This is the final cash flow which ends up either in your hand or to the government hand. So this is how royalty tax regime works. Now in the royalty tax regime, royalty calculation becomes a critical component, and I'll discuss in brief about the basis of royalty calculation. Royalty could be based either on the volume of oil or gas that you have produced, or it could be based on the cumulative volume. Generally speaking, royalties are based on revenue, and the royalty calculation will also depend on the location of the rig or field or the water depth where the rig is situated. As discussed earlier, royalty is again calculated differently for oil and gas and other streams. If there, for example, say there is a condensate, then royalty will be calculated differently for condensate. So royalty basis will differ for different streams of oil, gas and condensate. This is about the basis of royalty. Another aspect of royalty calculation is the royalty rate mechanism. Most of the time, royalty rate mechanisms are based either on incremental scales or step function or interpolate function. At the very high level, when I say royalty rate is based on your step function, that means your royalty rate will be applied to the total volume of the oil or total revenue of the oil, whereas in incremental case you will have different royalty rates for different tranches of revenue or different tranches of production. So your first year of production will be having a certain royalty rate. Your next level of production will attract a different royalty rate, and if you have a third level of production, then it will have a different rate, altogether different from the first and second tiers. So your different volumes will attract different royalty rates. That is a very high level definition of incremental calculation. Now that we have calculated the royalty, we need to know about our cost and deductions. Cost consists of your OPEX, G&G cost, XPEX, which is exploration cost, DevEx, which is development cost, and there is one more cost which comes at the end of field life, which we call as abandonment cost or ABANDEX. And all these constitute our total cost. But for taxable income, or for calculating the taxable income, not all of these costs are allowable deductions. Only a certain portion of our total cost is used for allowable deductions, of which the first one is the OPEX. OPEX is the portion of cost which means our operational expenditure, and all our operational expenditure are expensed in the same current year. Whereas capital expenditure, which constitutes of G&G or geological and geophysical cost, exploration cost, XPEX, or development cost, DevEx, they become our capital expenditure. And all the capital expenditure can be again classified as tangible capital expenditure or intangible capital expenditure. And the intangible capital expenditure is expensed in the same year 100%. Whereas tangible capital expenditure, they are not expensed in the same year. Instead, they are depreciated based on certain rules, which could be your straight line depreciation or declining balance, or UOP based, which means unit of production based depreciation. So your capital expenditure will be either expensed or depreciated, and that will decide your deduction. Apart from that, there is one more layer of deduction, which is called uplift. Uplifts are nothing but extra deduction that you can do based on your certain cost. For example, you have say $100 million of investment, and government allows you to take uplift of 50% of that cost. So you can use not only $100 million but 50% of that as well. That will make your total cost deduction $150 million. So this is how we do our deduction calculation, and this is very important for the taxable income. Our taxable income is nothing but the gross revenue minus royalty minus deductions. That is equivalent to our taxable income. And then you apply a tax rate on the taxable income. if your taxable income is positive. In case there is a negative taxable income, then you don't allow any tax to be paid for that, and because then you are effectively having an accounting loss. So you will pay a tax only if you have a positive taxable income, and you will not pay any tax if you have a negative taxable income or loss. So this is the basic scheme of royalty and tax calculation in a royalty based fiscal regimes. In my next video, I'll talk in detail about the several layers of calculation for before tax cash flow and taxable income and after tax cash flow. I hope this makes some sense to you, and I hope you like this. If not, then please let me know so that I can modify it for a better video in my future. And thank you very much for watching this.